These people are using the suppression of the Western market against us. Look at the deliveries off the Shanghai Gold Exchange. They're off the charts. So they're bleeding dry the LBMA and the COMEX, and the deliveries are off the charts. See the bigger picture? If not, you're going to get rolled over by this when it all breaks.
Imagine waking up tomorrow to find that your silver investment has not just doubled, but tripled in value. Impossible? Not according to Andy Schectmen, the seasoned precious metals expert who is making headlines with his bold prediction. Silver prices skyrocketing to $3,000 in the near future. Why does he believe such an astronomical surge is just around the corner? In this video, we're going to delve deep into Schectmen's analysis, exploring the global economic shifts and market dynamics that could turn this seemingly improbable scenario into reality. Stay tuned as we unpack the potential for a historic rally in silver.
And your imagination and try to think what could possibly happen. When you talk about nationalization of IRAs, yes, that could happen. We've talked about that on this show before, a bill that made it down to the House floor in 2009 that proposed just that if, all hell breaks loose, that they would, at the time, there was only it shows how fast the debt has grown, doubled since then, because I remember, if memory serves me right, it was $17 trillion debt, almost dollar for dollar with $17 trillion in U.S. IRA funds. And the idea was to, if things got bad, to sequester those funds, put them in what amounted to an IRA backed by the government, backed by U.S. treasuries. A $17 trillion injection into the treasury market would, in their minds, stabilize things. It would be a guaranteed annuity. But that means whatever you were invested in that IRA, well, too bad for that. I don't think they really thought the whole thing out well, because as you would sell one asset to buy another, there would be reverberations all over the place. But it, needless to say, was voted down. It didn't make it past just being a bill. But the genie was let out of the bottle. It is something they understand. When we talk about storage facilities, this is why I work with BRICS in our own private storage program, because they have the balance sheet. They are a behemoth. They to me, in an imperfect world, are as good as it gets. I mean, as you were saying, you can always find a problem. And this is the ultimate, really the description of why gold and silver are so important, at least in this respect, in a world of counterparty risk, to have an asset that is no one else's liability and holding it in your own possession. But there are times you can't do that. So we try and think that through and find the best option. We believe we have. Even in an IRA, if the custodian goes upside down, but the metals are held at a depository, not in cash in their bank account at the custodian, I think you're better off than most, in the ability to go and take possession of it if you need to, or have it shipped is always an option. So in a world of imperfect choices, I think these, at least address some of the concerns. But you're right, there is no magic bullet. But being awake, being alert, and trying to be a step or two ahead of the masses anyway, that's about the best you can do, along with preparing the best you can for what could potentially be the worst.
Before we dive into the swirling currents of the silver market, let's first understand the man behind the recent headline-grabbing forecast. Andy Schectmen is the president and CEO of Miles Franklin Precious Metals, a company steeped in the business of buying, selling, and discussing precious metals. Schectmen isn't just any market analyst. He's a recognized voice in the precious metals community, known for his deep market insights and a keen understanding of economic trends affecting gold, silver, and beyond. In a bold statement that caught the attention of investors and analysts worldwide, Andy Schectmen predicted that silver is not just on the brink of an upturn, but poised for a monumental rally that could see prices soaring to $3,000 per ounce. Such a prediction might seem outlandish at first glance, given the current silver price hovering around the $28 mark. However, Schectmen bases his forecast on a confluence of economic indicators, market dynamics, and geopolitical factors that he believes will drastically alter the supply-demand landscape of silver. Why does he believe such a dramatic rise is imminent? Schectmen points to several key drivers. The weakening U.S. dollar. As the world's reserve currency faces increasing pressure from economic policies and debt levels, its value could continue to decline, making silver, which is priced in dollars, more attractive and more expensive. Geopolitical tensions and economic policies. From trade wars to sanctions and beyond, global tensions are high, and nations are increasingly looking to diversify away from the dollar. This trend could increase demand for silver as a safe haven asset. Industrial demand. Silver's role in various industrial applications is expanding, particularly in areas critical to the new energy economy, like solar panels and electric vehicles. This industrial demand is set to significantly strain supplies, pushing prices up. Investment demand. During times of inflation and economic uncertainty, investors traditionally turn to precious metals. With rising interest in silver, both as an investment and a hedge against inflation, its price could escalate quickly. Schectmen also discusses the role of emerging market economies, particularly the BRICS nations, Brazil, Russia, India, China, and South Africa, whose growing economic power and increasing dissatisfaction with the dominance of the US dollar in global trade could lead to greater reliance on and accumulation of silver and other precious metals. This isn't just about market speculation, it's a reflection of a potential shift in the global economic order, one where silver could play a pivotal role not just as a precious metal, but as a cornerstone in the future of global finance and trade. Schectmen's forecast isn't merely an outlier's view, but a calculated prediction based on trends we're seeing in the market today. As we explore the depths of this prediction, keep in mind the layers of complexity involved in the global silver market. It's a world influenced by countless variables, from mining supply constraints and recycling rates to technological advancements and international monetary policies. Understanding Schectmen's prediction requires us to navigate these waters carefully, examining each factor and its potential impact on the future price of silver. In our next segments, we will dissect these drivers more closely, providing you with a comprehensive view of the silver market from multiple angles. Stay tuned as we break down the intricate dance of economics, market psychology, and resource scarcity that could lead to one of the most spectacular financial phenomena of our time.
I mean, look, what's happening right now with gold and the bonds? Why would any country, like, look at China. They used to have almost 3 trillion in treasuries. They're down to just over 700 billion. Why would any country want to hold any of our debt of any duration when this stuff is happening? When we go around the world imposing sanctions on everyone and now confiscating those assets. And, it's okay for us to do it, but you can't. So, but hey, take our debt, please. We need to build our military because we've borrowed all this money to other countries that we really don't have. But why would anyone want to hold our debt of any duration whatsoever? And the answer is they won't, because we've chosen inflation over austerity. We know that if we raise rates, we blow everything up. If we lower rates and inject inflation and signal that we will never balance or normalize our balance sheet and let the inflation engine run, well, it leads to the same place of higher interest rates. And so the Fed's trapped and they know it. Why would anyone hold these long-term duration bonds? And so, when you talk about the banks, right? Ultimately, I've said for a very, very, very long time that interest rates spike to the moon as people dump our treasuries. Well, it's happening. The little by little by little, it's happening. You can see it. Now, we're supposed to believe that the United Kingdom and Ireland and the Cayman Islands are next to the Federal Reserve, will be the biggest holders of our debt. The UK is going to pass China here very quickly. And Jim Willey, I love the guy. He's got courage to say things I don't. He says that Ireland and UK and Cayman are being funneled money by the Fed under the table to do this. Because why the hell would they want our treasuries too? They're not dumb. They see what's happening. And to keep the game going a little bit longer, we have a situation where the countries that were always buying our treasuries are now selling them and replacing it with oil and gold, because these are assets that have no counterparty risk and are demanded across the majority of the globe. It's a new system where gold and oil are being remonetized, in my mind, in favor of the U.S. Treasury. You're seeing de-dollarization and de-treasurization. So when you talk about a bank that failed, well, yeah, look at all the 185 banks that you mentioned on Razor's Edge. What will break it? Rates rising. Well, Powell said that his mentor was, what's his name? The former Paul Volcker. Volcker was his mentor for raising rates to 18.75%, right? Well, he ain't no Paul Volcker, because he realized that he got, you get to 5% on the 10-year treasury, you're going to have things start to break. And he's not doing that. So how about the villain theory that I've talked about endlessly? Make people say, what the hell is going on in the United States? And look what they're doing around the world, and they're broke. We don't want it anymore. And besides, they're going green. They don't want to be part of the oil gang. And so besides, all those guys are now joining the BRICS. It's time to go move another way. And all these countries dump dollars. Or they just say, we're not taking dollars for oil anymore. I mean, you can see it. And maybe this is why you're seeing the yen so low to keep that carry trade going, to keep the dollar strong. I mean, I don't know what the hell's going on anymore other than to say ultimately I see rates going much higher, because there is no way they can ever normalize the balance sheet. Either the whole thing blows up or they choose inflation. It's one or the other. And there is no other way they can do it. And rates will go higher. What does that mean for the banks? What does that mean for the insurance companies? So yeah, when you talk about the great taking, the risk, and how undercapitalized and over leveraged this whole system is, including the FDIC, which during this banking funding cost the FDIC $667 million. That they only have 1.8 billion in their account, or less than that, backing 18 trillion. So I mean, how many more banks? This is a small one. How many more can fail before boom?
As we delve into the complexities of the silver market, it's important to recognize that while today's prices hover just above $28 per ounce, the potential for growth goes far beyond mere speculation. Silver, often seen as both a financial safe haven and a vital industrial metal, stands at the crossroads of numerous economic forces and supply chain dynamics. The current state of the silver market is shaped by a delicate balance between its traditional role as a store of value and its increasing importance in various industrial applications. Unlike gold, silver straddles the line between precious and industrial metal, making it uniquely sensitive to both economic trends and technological advancements. Starting with the economic landscape, we see a global economy characterized by uncertainty. Inflationary pressures in major economies, coupled with ongoing geopolitical tensions, have prompted investors to increasingly turn to silver as a hedge against inflation. This rising investment demand is buttressed by a growing awareness of silver's role in areas such as renewable energy technologies, where it is indispensable for solar panels and other green technologies. On the supply side, the production of silver has faced several challenges. Mining operations have been disrupted by stricter environmental regulations, political instability in key producing countries, and the lingering impacts of global health crises on labor and industrial output. These factors have constrained the growth in silver supply at a time when demand from both investors and industrial sectors is climbing. Furthermore, the recycling of silver, another significant source of supply, has not been able to keep pace with this rising demand. While technological improvements have made recycling processes more efficient, the overall contribution of recycled silver to the market remains limited compared to the new silver extracted from mines. Meanwhile, the technological demand for silver continues to surge. Beyond its established uses in jewelry and coinage, silver is critical in the electronics industry due to its unmatched thermal and electrical conductivity. Every smartphone, tablet, and laptop relies on silver components, which means the tech industry's exponential growth directly fuels demand for this versatile metal. The financial markets have reacted to these dynamics with a cautious optimism about silver's price trajectory. The increasing industrial demand coupled with investment flows into silver-based financial instruments like ETFs suggests a bullish outlook, yet the market remains vigilant, aware that any shift in macroeconomic policies or technological breakthroughs could further disrupt this balance. As we explore these intertwined factors, it becomes clear that the silver market is not just reacting to current economic conditions, but is also shaping them. Each fluctuation in silver prices reflects deeper changes in the global economy, from the push for renewable energy and sustainable technologies to the shifts in monetary policies and investment strategies. In essence, the journey of silver prices from their current levels to the heights predicted by Andy Schectmen is not merely a possibility, but a pathway being paved by a confluence of robust demand, strained supply, and profound economic shifts. This narrative, woven through the fabric of global market trends and industrial needs, sets the stage for a potential historic rally in silver. In our next discussion, we will examine how specific economic movements, particularly those involving the US dollar and international trade policies, play a crucial role in shaping the future of silver prices. Stay tuned as we continue to unravel the layers of this compelling market saga.
Look at St. Louis, the former one AT&T center that was sold for $205 million in 2006. I mean, someone wants a very big home, you can go buy it. It just sold for $3.6 million. Just recently. So in 2006, it was sold to a REIT for $205 million. And now it's just sold for 1.5% of that for $3.6 million. You can't make it up. What do you think St. Louis is like right now, or the Holiday Inn Express in Washington, D.C.? The only person bidding for it was the lender. That's it. It was in foreclosure, and they paid $18.5 million for it. And the lender was owed 83 million on it. And you talk about an 80% write down. So this is going on all throughout the big cities, and it's not stopping. And so expect, as the commercial real estate problem grows, expect more of this, where taxes are going to go higher because the people that own these businesses that are leaving, that are being targeted, they're going to leave these crime-ridden big cities, and it will only get worse. And this is, again, go back to the Cloward-Piven theory. What do you got? Big cities that are overrun, that become massive entitled.
In the vast arena of global finance, the strength of the U.S. dollar holds monumental sway over commodity prices, including silver. Historically, there has been an inverse relationship between the dollar and commodities. As the dollar weakens, commodities priced in dollars, like silver, tend to rise. This phenomenon is rooted not just in the mechanics of currency conversion, but also in the deeper economic narratives that drive investor behavior worldwide. The dollar's position has been somewhat precarious of late, influenced by a complex mix of fiscal expansion, varying interest rates, and geopolitical tensions. In the face of these pressures, we're witnessing a gradual yet noticeable decline in the dollar's dominance. This decline is catalyzed by the aggressive monetary policies adopted by the Federal Reserve in response to global economic challenges. These policies, while aimed at stabilizing the U.S. economy, often result in a softer dollar as interest rates are cut and money supply is expanded. Furthermore, the ongoing trade disputes and sanctions have urged nations to reconsider their reliance on the dollar. Countries, especially those in the BRICS group, Brazil, Russia, India, China, and South Africa, are increasingly exploring alternatives to the dollar for their international trade. This shift is motivated by a desire to mitigate their exposure to dollar-centric economic policies and sanctions. As these nations reduce their dependency on the dollar, they inadvertently boost the appeal of commodities like silver, which becomes a more attractive investment in a diversifying global economy. As the dollar's influence wanes, silver gains a dual boost. Firstly, it becomes cheaper for holders of other currencies, increasing its demand as an investment. Secondly, as uncertainty surrounding the dollar grows, investors globally seek safety in traditionally secure assets like precious metals, which historically preserve value in times of currency devaluation and economic turmoil. This transition is not just about the shifting sands of currency strengths, but also reflects a broader revaluation of economic security and stability in a multipolar world. As economies around the globe navigate through the challenges posed by a declining dollar, silver's role as a financial safe haven becomes ever more critical. Its inherent value, coupled with industrial utility, positions it as a compelling choice for safeguarding wealth. Investor sentiment is also crucial in this dynamic. As confidence in traditional fiat currencies wavers, the psychological appeal of silver, a tangible asset with intrinsic value, grows. This sentiment is amplified by the metal's historical performance during periods of inflation and dollar depreciation, further embedding it in the investment strategies of those looking to hedge against currency risk. In summary, the interplay between the weakening dollar and rising silver prices is a narrative of economic cycles, investor psychology, and global market dynamics. This complex relationship underscores the broader economic principles that govern commodity markets while highlighting the unique position of silver as both an industrial staple and a bastion of value in turbulent times. As we continue our exploration, the impact of BRICS nations on silver's ascent will come into sharper focus, illustrating how geopolitical and economic strategies from emerging markets are reshaping the global demand for this versatile metal. Stay tuned as we further unravel the intertwined dynamics of global economies and silver markets in our next segment.
Yeah, and it's probably not for most of the people listening to this podcast. Some of them maybe. Certainly some of the people you have on your show would have problems to worry about this. You'll see what I mean. From the you can't make it up category, as part of President Biden's, if he wins, his budget proposal for 2025 fiscal year, they're trying to raise an additional $4.3 trillion over 10 years. And I'll stop right there and say maybe if they just stop giving money to every other country around the world, we could probably save more than that in 10 years. And giving away $200 billion to the Ukraine, as an example, is probably not a great idea, but from a broken, insolvent country. But I digress. Anyways, he wants to raise $4.3 trillion over 10 years by raising the capital gains tax and by imposing, and by the way, he wants to raise the capital gains tax to over 44%, I believe, 44.5%, I think is the number. The reason I said it's not for everyone here, listen to this. He wants to raise the he wants to apply an unrealized capital gains tax for people with wealth over $100 million. And now, I mean, from the too stupid to be stupid category, these are the people that are the wealth creators. These are the people that have lots of money in unrealized gains in things like NVIDIA and in Bitcoin. And if all of a sudden he thinks that he's going to impose what is, to me, about as uncapitalistic and un-American as it can be, a unrealized gain tax of 25% on the wealthy people. You see, I left Minnesota and I voted with my feet. It was a hard decision. I'm not a centimillionaire, but I picked up camp when I left. It cost me money, but I haven't looked back. But the guys with that kind of money, they'll just leave the country. And they'll pull with it all of their businesses. They'll sell all their securities. They'll just be gone. And leaving a vacuum of tax receipts now that they have to fill from someone else. This Robin Hood style take from the rich and redistribute to the poor. Well, that goes right in hand with what we talked about last week in in what's it called? The Cloward-Piven theory, where, you read the redistribution of wealth. That's exactly what this is. From a country whereby if you spent $100 every second of every day, it would only take 1,966 years to equal the $6.2 trillion that this administration foolishly spent over the last 12 months. So instead of reining in their spending, which would really be the smart thing to do, they want to tax the people who have all the wealth. And those people largely are the ones that help the economy go, and largely are the ones that invest and own businesses. And they'll be the ones to pick up tent and move to their yacht in the middle of some tax haven country, in the Caribbean. All I'm saying is it's a continuation of stupidity that really bothers me. And I don't know your feelings on it, but that's not the way to solve this problem. The solving of the problem starts with reining in the ridiculous fiscal policy that we have, where it's almost like a heroin addict who can't say no and can't stop spending, and worse yet, borrowing money at increasing interest rates
as the global
to lend it out
economy
across
becomes
the
increasingly
globe.
interconnected.
You just can't make
the
it up.
economic strategies and policies of BRICS nations, Brazil, Russia, India, China, and South Africa, play a pivotal role in the dynamics of commodity markets, including silver. These countries are not only burgeoning economic powerhouses, but also significant players in the global trade of commodities, influencing both the demand and pricing of silver on an international scale. The BRICS bloc has been actively working to reduce their dependence on the US dollar in international trade. This shift is part of a broader strategy to enhance their economic sovereignty and reduce exposure to dollar fluctuations and geopolitical risks associated with US monetary policy. By promoting the use of their local currencies in bilateral trade agreements, these nations are fostering a more diversified and resilient economic environment. For silver, this means a potential increase in transactions denominated in currencies other than the dollar, which could enhance its attractiveness as an investment and reserve asset. China, in particular, plays a critical role in the silver market due to its substantial industrial demand. As the world's leading producer and consumer of solar panels, one of the largest industrial uses for silver, China's push towards renewable energy is a significant driver of global silver demand. The country's ambitious plans to expand its renewable energy capacity are expected to require vast amounts of silver, putting upward pressure on prices due to the metal's essential role in photovoltaic cell production. Moreover, the economic policies of BRICS nations often emphasize infrastructure development and technological innovation, sectors that are heavily reliant on silver. From high-speed railways in India to advanced electronics in China and renewable energy projects across Brazil and South Africa, the expansive growth in these sectors fuels a robust demand for silver, further tightening global supply constraints. The influence of BRICS on silver is also evident in their investment behaviors. Central banks in these countries have been diversifying their foreign exchange reserves by increasing their holdings in precious metals, including silver, as a hedge against currency devaluation and inflation. This trend not only supports higher silver prices, but also underscores the metal's evolving role as a financial asset on the global stage. As these nations continue to grow and assert their influence on the global economic landscape, their collective push towards reducing dollar dominance in trade and increasing investments in silver can lead to greater price stability and potentially higher prices. The strategic economic maneuvers of BRICS countries are thus not just reshaping their domestic markets, but are also setting the stage for significant shifts in global commodity markets. In conclusion, the impact of BRICS nations on the silver market encapsulates a multifaceted dynamic of increased demand due to industrial growth and investment diversification. As we observe these trends, the scenario where silver reaches the heights of $3,000 becomes not just a speculative possibility, but a foreseeable outcome driven by concrete economic developments. Next, we will look at how specific industrial demands, particularly from burgeoning technologies, are expected to impact the supply and demand of silver, painting a clearer picture of its potential trajectory towards the $3,000 mark. Stay tuned as we continue to piece together this intricate puzzle of economic forces and market potentials.
Act 4175, basically to seize the Russian assets. And of their Forex reserves, 5 billion of them are here in the United States for sure. And well, they want to seize those assets and give them to the Ukraine. I mean, you can't make it up. And this is probably why you just saw a Russian court that ordered seizure of $440 million held by, in JP Morgan assets. And it's tit for tat. But you can't make it up. I mean, we go around telling China, you're not allowed to give any money to Russia, your ally in the BRICS. If you do, we will sanction your banks, your companies, and even Beijing. But we can not only give to Ukraine $200 million with no congressional oversight, we can actually seize the assets, the Russian Forex reserves, and they're begging their allies in the G7 to do the same thing. They have to have kind of a unanimous decision to allow this, including the funds in the European Union. But they want to take all this money and give it to the Ukraine so we can take your assets because we don't align with you, even though most of the countries think we're hypocritical, and then give it to the country you're fighting on top of already giving them, $200 billion in aid and providing logistics and support and weapons. And it's just, you have to wonder what's going on. Dunnigan, I don't understand how this could even be thought acceptable. And I don't care how you feel about Russia. I mean, when you cross the line as the reserve currency, it was bad enough to sanction and weaponize. It's a whole nother thing to confiscate and then give the assets to a foe that you're in the middle of a war with. I mean, they'll write about this in history books as the epitome of stupidity. Or maybe it will be discovered this is what they were doing to try and elicit a reset. I don't know which one it is, but I mean, you have to ask yourself, okay, is there a middle ground here? Either it's ridiculously stupid or they're trying to do something. And to see the continuation of sanctions, I mean, and people, look, if this administration wins current, I fear for this country. But look, I think Biden or I think Trump should be the president. I think he'll be a whole hell of a lot better. But even he's dumb in talking about sanctioning other countries if they stop using the dollar, like the BRICS. You can't sanction. You have to stop. The country has to stop going around being coercive and being the big bully that everyone is rallying against. This is the rallying cry. And whether it be, I mean, God help us if the current administration wins, we're in big trouble. And if Trump wins, great. I think we have a better chance of slowing things down. But even him saying publicly, we will sanction countries that try and move away from the dollar. No, you can't do that.
In our journey through the layers of factors influencing the silver market, one of the most dynamic and perhaps most critical aspects to consider is the booming industrial demand coupled with rapid technological advancements. Silver's unique properties, primarily its exceptional electrical conductivity, make it indispensable across a variety of applications, propelling it beyond mere ornamentation into the heart of modern technological innovation. The surge in industrial demand for silver is largely driven by its essential role in the green technology sectors, particularly in photovoltaic cells used in solar panels, and its use in the burgeoning field of electric vehicles, EVs. As global initiatives to combat climate change accelerate, investments in renewable energy technologies are increasing. Solar energy installation, for instance, has seen exponential growth worldwide, with countries like China, the United States, and members of the European Union leading massive rollouts of solar infrastructure. Each solar panel requires a substantial amount of silver, and with the International Energy Agency projecting solar power as the future king of electricity, the implications for silver demand are substantial. Moreover, the automotive industry's shift towards electric vehicles further compounds this demand. Silver is crucial not only in electric contacts and conductors within the vehicles, but also in the infrastructure that supports them, such as charging stations. The expected increase in EV production, driven by governmental policies aiming for a reduction in carbon emissions, is set to significantly impact silver demand. Analysts project that by the next decade, millions of ounces of silver will be required annually just to meet the needs of the EV sector alone. Beyond energy and automotive applications, silver is also pivotal in numerous other high-tech areas, including smartphones, tablets, and other consumer electronics, which remain in high demand globally. The rapid pace of technological innovation ensures a continuous demand for silver, given its unmatched thermal and electrical conductivity. This mounting industrial demand comes at a time when silver supplies are under pressure. Silver mining outputs have been relatively stagnant, and although recycling efforts provide some relief, they are insufficient to bridge the gap between burgeoning demand and constrained supply. The result is a tightening market where any additional increase in industrial use can push prices significantly higher. Furthermore, the development of new technologies can often lead to unexpected increases in demand for materials like silver. Innovations in sectors such as medical technologies, which utilize silver for its antibacterial properties, and in areas like flexible electronics, are emerging as new drivers of demand. The cumulative impact of these factors creates a robust case for a significant rise in silver prices. As industries continue to expand and evolve, the demand for silver is not just sustained, but is set to increase exponentially. This trend, supported by the global push towards sustainability and electrification, paints a promising picture for those investing in silver, suggesting that Schectmen's prediction may not be as far-fetched as it seems. In this complex tapestry of supply constraints and burgeoning demand, the path to $3,000 per ounce of silver becomes increasingly plausible. Each technological advancement and each shift towards sustainable energy not only supports current demand levels but potentially escalates them, setting the stage for a dramatic revaluation of silver as a key industrial commodity. Next, we'll analyze historical data and future projections to further understand how past trends might inform future trajectories in the silver market, helping to validate or challenge the prediction of a significant price rise. Stay tuned as we connect historical insights with forward-looking speculation.
Some point there. I mean, look, 400,000 a year or thereabouts, I think, is the number. That's a lot of money, right? It is, but it's not what it was when you and I were young and kids. 400,000 would have been enough, people would dream of that. And it still is a lot of money. But to say if you're making over 400,000 a year that you don't get any of the exemptions, you don't get any of the anything, and you're taxed at these super high levels, that's I kind of think what you're referring to. 400,000, 15, 20, 30 years ago was a ton of money. It still is a lot, but it doesn't go anywhere near as far as it used to. And they're right. You're right. Inflation gets you up closer and closer and closer, builds up the number of people that, I'm not saying that all these people have 100 million in wealth because of inflation, but I wouldn't be surprised to see them go the other way. Well, we're going to drop it down to if you have 30 million in wealth, that's still more than everyone owns. And they'll just keep finding ways to increase taxation. This is reminiscent of what a long time ago we were saying that it's inevitable that stagflation is coming. Higher taxes, lower productivity, and inflation. I mean, that's it. That's where we're heading. Now, there's a lot that needs to happen for this to get passed, including him winning the election. But the point of it is that that's the thought process of the.
In our quest to understand the potential for silver to surge to $3,000 per ounce, it is crucial to juxtapose historical performance with projected market conditions. Historically, silver has exhibited volatility, but also resilience, serving as both an industrial staple and a haven in times of economic uncertainty. Let's dissect the patterns and the cycles that have defined silver's past and consider how they might shape its future. Silver's historical price movements have often been influenced by a mix of macroeconomic factors and sector-specific demands. For instance, the Hunt brothers' attempt to corner the silver market in the late 1970s led to a dramatic spike in prices, followed by an equally dramatic fall. While such anomalies are outliers, they underscore the metal's susceptibility to speculative pressures and market manipulations. More consistently, however, silver prices have responded to standard supply and demand dynamics, monetary policy changes, and global economic health. In the early 2000s, a renewed interest in commodities, driven by rapid industrialization in emerging markets, especially China, pushed silver prices upward. This trend was amplified by the 2008 financial crisis, which saw investors flocking to silver and other precious metals as safe haven assets amidst widespread market turmoil and currency devaluations. The subsequent recovery phase saw silver prices correcting as global economies stabilized and investor appetite for riskier assets returned. Turning to more recent trends, since 2020, the COVID-19 pandemic has had a profound impact on global markets, including silver. Initial drops in price due to industrial slowdowns were quickly reversed as the crisis underscored silver's role in medical applications and as an investment hedge against inflation and currency devaluation concerns raised by massive governmental fiscal stimuli. Looking ahead, future projections for silver are shaped by both enduring and emerging trends. The ongoing global shift towards renewable energy and electrification continues to solidify silver's role in the industrial sector. Analysts from the Silver Institute and major financial institutions project an increase in demand from industries such as solar energy and electronics manufacturing, which could significantly strain existing supplies. Moreover, the potential for inflationary pressures as global economies recover from pandemic-induced downturns could enhance silver's appeal as an investment hedge, further driving up prices. The anticipated continuation of loose monetary policies in major economies, notably the United States and the European Union, could also devalue currencies and push investors towards precious metals. Combining these factors with the enhanced market participation from retail and institutional investors, as seen through the rise of silver-based financial products, we can delineate a scenario where silver could indeed approach the $3,000 mark. This would not merely be a speculative spike, but rather a result of sustained increases driven by fundamental changes in the markets and global economy. In essence, while the historical performance of silver provides us with insights into its potential volatility and growth trajectories, the unique confluence of current and expected future conditions suggests that we might be on the cusp of a new era for silver. One where its dual role as an industrial necessity and monetary safeguard propels it to unprecedented heights. As we continue to piece together this narrative, the informed speculation and synthesis of these trends will be crucial in our next section, where we fully explore the possible pathways that could lead silver to reach or even exceed $3,000 per ounce. Stay tuned as we conclude our exploration with a detailed look at the potential market movements and economic developments that could make this scenario a reality. As we approach the culmination of our discussion on the potential for silver to reach $3,000 per ounce, it's essential to synthesize the array of economic, geopolitical, and technological dynamics we've explored. This apex of our analysis aims to provide not just a summary, but a forward-looking perspective grounded in a nuanced understanding of the various forces at play. The journey towards a $3,000 silver price is underpinned primarily by the weakening US dollar, which continues to lose its grip as the global reserve currency amid escalating national debts and aggressive monetary expansion. This depreciation inherently boosts the appeal of silver as an investment as it becomes more affordable for holders of other currencies, thereby increasing global demand. Concurrently, the economic rise of the BRICS nations introduces a significant shift in the global economic order. Their growing disdain for dependency on the dollar and increased consumption due to rapid industrialization create a robust demand for silver, particularly given its applications in burgeoning industries like solar energy and electronics. Moreover, the relentless advance of technology perpetuates an ever-increasing demand for silver. From photovoltaic cells powering the green revolution to the latest uses in 5G technology, silver's role is expanding beyond traditional sectors into new realms that are essential for modern infrastructure. This expansion is not without its challenges, primarily the strain it places on the already limited silver supply. Industrial demand, particularly for green technologies, presents a compelling case for rising silver prices. As countries globally commit to renewable energy targets and carbon neutrality, the demand for silver, critical for solar panels and other green technologies, is set to skyrocket. This surge occurs just as silver mining faces numerous challenges, from environmental regulations to geopolitical tensions that hindered the ability to rapidly increase supply. The investment demand for silver further complements its bullish outlook. In times of inflation and economic uncertainty, silver has historically served as a safe haven, akin to gold. The increasing interest from institutional investors and the proliferation of silver-based financial products provide a strong investment inflow, pushing prices higher. All these factors coalesce into a powerful narrative supporting Andy Schectmen's prediction. The combination of a weakening dollar, strong industrial and investment demand, and constrained supply outlines a plausible pathway for silver prices to achieve and possibly exceed $3,000 per ounce. While this prediction may seem ambitious, The alignment of these influential factors creates a compelling argument for such a scenario. In conclusion, while the future is never certain and markets are inherently unpredictable, the detailed analysis of underlying trends and market dynamics provides a robust framework for understanding potential future price movements in silver. The journey to $3,000 silver is not just a speculative leap, but a trajectory grounded in real, observable market phenomena and economic shifts. Remember, while we provide this analysis to offer insights and inform, it is essential for each investor to conduct their own research and consider their financial circumstances before making investment decisions. As we continue to monitor these developments, stay subscribed for updates and discussions on these exciting market dynamics. Thank you for joining us in this comprehensive exploration of the silver market. Until next time, keep an eye on the markets and continue to seek out knowledge that informs your investment decisions. This concludes our in-depth analysis of the potential for silver to reach $3,000 per ounce. By considering the intricate web of factors we discussed, investors and market watchers can better understand the dynamics that could drive such a significant price movement in the silver market. In our quest to understand the potential for silver to surge to $3,000 per ounce, it is crucial to juxtapose historical performance with projected market conditions. Historically, silver has exhibited volatility, but also resilience, serving as both an industrial staple and a haven in times of economic uncertainty. Let's dissect the patterns and the cycles that have defined silver's past and consider how they might shape its future. Silver's historical price movements have often been influenced by a mix of macroeconomic factors and sector-specific demands. For instance, the Hunt brothers' attempt to corner the silver market in the late 1970s led to a dramatic spike in prices, followed by an equally dramatic fall. While such anomalies are outliers, they underscore the metal's susceptibility to speculative pressures and market manipulations. More consistently, however, silver prices have responded to standard supply and demand dynamics, monetary policy changes, and global economic health. In the early 2000s, a renewed interest in commodities, driven by rapid industrialization in emerging markets, especially China, pushed silver prices upward. This trend was amplified by the 2008 financial crisis, which saw investors flocking to silver and other precious metals as safe haven assets amidst widespread market turmoil and currency devaluations. The subsequent recovery phase saw silver prices correcting as global economies stabilized and investor appetite for riskier assets returned. Turning to more recent trends, since 2020, the COVID-19 pandemic has had a profound impact on global markets, including silver. Initial drops in price due to industrial slowdowns were quickly reversed as the crisis underscored silver's role in medical applications and as an investment hedge against inflation and currency devaluation concerns raised by massive governmental fiscal stimuli. Looking ahead, future projections for silver are shaped by both enduring and emerging trends. The ongoing global shift towards renewable energy and electrification continues to solidify silver's role in the industrial sector. Analysts from the Silver Institute and major financial institutions project an increase in demand from industries such as solar energy and electronics manufacturing, which could significantly strain existing supplies. Moreover, the potential for inflationary pressures as global economies recover from pandemic-induced downturns could enhance silver's appeal as an investment hedge, further driving up prices. The anticipated continuation of loose monetary policies in major economies, notably the United States and the European Union, could also devalue currencies and push investors towards precious metals. Combining these factors with the enhanced market participation from retail and institutional investors, as seen through the rise of silver-based financial products, we can delineate a scenario where silver could indeed approach the $3,000 mark. This would not merely be a speculative spike, but rather a result of sustained increases driven by fundamental changes in the markets and global economy. In essence, while the historical performance of silver provides us with insights into its potential volatility and growth trajectories, the unique confluence of current and expected future conditions suggests that we might be on the cusp of a new era for silver. One where its dual role as an industrial necessity and monetary safeguard propels it to unprecedented heights. As we continue to piece together this narrative, the informed speculation and synthesis of these trends will be crucial in our next section, where we fully explore the possible pathways that could lead silver to reach or even exceed $3,000 per ounce. Stay tuned as we conclude our exploration with a detailed look at the potential market movements and economic developments that could make this scenario a reality.